Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to take a trip into the past just to see what they were saying in 2007, right before the biggest financial collapse of our lives. So I think you guys are going to find it very interesting, and let me change what I said. I want to know if they're saying the exact same things in 2007 as they're saying right now in 2023. And I think you guys are going to be absolutely blown away. And what we're going to do, y'all, is we're going to dig into a video of Ben Bernanke. Now, Ben Bernanke was the federal chair, the Federal Reserve chairman back in the last great financial collapse of 2008, 2009. So we're going to listen to a video of him and see what he was saying to the public and Congress right before the biggest financial collapse. And then after that, you guys, I'm going to dig into some articles from 2007 and 2008, and we're going to read about what the media was telling the public back in 2007 and 2008. And again, we're going to compare that to what's going on today. Now, where I'm going to end, y'all, is I'm going to jump into unemployment and foreclosure, and we're going to talk about those things, and we're going to compare where we're at today versus where we were at right before the last financial collapse. Now, big shout out to my man, Jeff M. You guys, I talk to Jeff M., a subscriber on my channel, more than I do anyone else on YouTube, including Scott, Todd, Steve, any of those guys, Orlando. I talked to Jeff more, and me and Jeff were going back and forth last night, and Jeff was like, Travis, I got a great idea for a new video, and that is, let's compare the sentiment from 2007 to right now and see if we can see any similarities. So if you guys are happy about this video, give Jeff a shout out for that. Jeff, I really appreciate you, brother. And remember, you guys, this is just my personal ranting YouTube channel, so settle down a little bit, even though my bio is as a realtor, loan officer, and instructor in real estate, and I've lost everything already, so I kind of know what not to do. I'm a little bit hypersensitive to what's going on right now because it appears the same thing that's going on right now is what happened in the past, minus a couple things like unemployment, if you believe the numbers, and foreclosures. So that's what we'll do today, you guys. But again, remember, like this video, subscribe if you haven't already. And again, please, guys, like this video for me, please. Will you just like this video for me? Shoot me a comment below. But either way, you guys, let's get started on the video right now. And what we're going to do first is I'm going to have you guys listen to a few clips of Ben Bernanke. And remember, Ben Bernanke was like the Jerome Powell of today, but back in the past. Let's hear what Jerome Powell was telling the public right before the greatest financial collapse of our lives. Listen up.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
Again, this is a federal chairman, and a lot of people leaned on this man to help guide them through that last collapse. And he's basically sitting here saying, oh, I don't understand the narrative. Home prices have never collapsed before. And then shortly after, a lot of people got hurt. Shortly after, let's keep listening to the video.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth, not necessarily a national situation, but certainly froth in some areas?
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
So we have the federal chairman, Ben Bernanke, stating that he believes any type of bubble or price growth or any type of collapse is essentially localized. Do y'all hear that same narrative right now? Do y'all hear that same localized narrative right now, like it can't spread? And this is for you, Jeff. I know it's going to hit St. Louis. The thing that I don't know, though, is how bad. It's going to hit you guys because we're in the first inning. Just like in 2007, they were in the first inning, and everyone, including the chairman, held on to the narrative that everything is going to be okay. Y'all see the same thing happening right now? Let's listen to some more of this.
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy, and the lending side of that still seems to be healthy.
So again, I just want to point out that in 2007, the federal chairman, Ben Bernanke, said that he doesn't believe there's going to be a mortgage crisis. He said this man said this in 2007. And now that we're in 2023, we clearly know now, right? There is a massive mortgage crisis. So the fact that this person that so many people lean on is in 2007, okay? So 2007, he's still saying, this is fine. This is localized. There's not a subprime mortgage crisis. None of that, none of that is there. And again, the interesting thing about all of this, y'all, he had all of the data that could have painted the picture of what was actually happening. And if this man would have sounded the alarm maybe a little bit sooner, prepared us a little bit sooner, I believe a lot more of us that were paying attention, and most people weren't paying attention. In fact is, most people aren't even paying attention now, just like back then. So here's the thing, you guys, because so many people are not paying attention, they can get away with stuff just like this. Think about it. Think about it. Okay, let's continue.
However, even if demand stabilizes as we expect, the pace of construction will probably fall somewhat further as builders work down the stocks of unsold new homes. Thus, declines in residential construction will likely continue to weigh on economic growth over coming quarters, although the magnitude of the drag on growth should diminish over time. The global economy continues to be strong. Supported by solid economic growth abroad, U.S. exports should expand further in coming quarters. Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
All right, so 6 months after he says that, economic collapse, 6 months after he says that, and reassures us that everything's okay. Now, the reason I'm really pointing this out, y'all, is so many people last time were so blind, were so naive to just the possibility that we should be cautious. So many people were blind. They essentially woke up one night in the housing market crash, and it blindsided them. So in other words, y'all, what I'm really trying to say right now is just pay attention. Even if you don't agree with me or everything that I'm saying, at least consider the possibility that this housing market right now is crashing and will continue to. But I understand that's really hard to get a gauge on because our own people are misleading us. Let's listen to a little bit about what Jerome Powell has been saying and compare it to what Ben Bernanke just said.
I mean, I think there is a possibility on the other side of this that inflation could actually be quite low, and pace of that are highly uncertain, and that inflation has persisted longer than we thought.
Right, but some of it does appear to be transient or idiosyncratic. Now, the second, if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we ideally do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels.
So generally, when the Fed speaks, things are much worse than they really are. So if he's saying to prepare, mildly saying to prepare, how bad are things really? So just put that in perspective. Pretty much every single time they're warning us of something, again, things are much worse than they appear. Financially critical times like we're in right now. But also what I want to talk about, because so many forget this, is let me explain one more time to you guys what the problem is and what happened exactly. In order to understand what happened, we have to pull up the median sales price for houses sold in the United States. This is Fred economic data, as you can see right here. So what I really want to point out is, and this goes back, y'all, all the way to 1963. Now, this is essentially equity growth, and we can see it's been pretty, comparably pretty balanced. And then right about here in, let's just say Q3 of 2003, that's when we had that run up in equity. Okay, so that's when we had the run up in equity. Obviously, shortly after, there was a housing market crash right here. Okay, so what I really want to point out is how much faster, as you guys can see right here, how much faster and how much worse the run up in equity is actually right now. So again, problem number one, y'all, home prices went up way too much and broke every single fundamental made to protect us. As you can see with this graph right here, the housing market isn't crashing. Just buy, find a great deal and just buy. Yeah, I believe in finding a great deal, right? Way under market value, cash flowing and things like that. But I'm not going to sit here and say certainties and things like that when we had a massive run up. Someone's going to pay for this, and it's probably going to be the people that purchased in the last 2 years. Now, one of the reasons for that equity run up was the historically low interest rates. Here's the Fred economic data 30-year fixed rate mortgage average. And really what I want to show you is, back before we went into the crash, y'all, interest rates were in the 5 and 6%, mostly in the 6%. Look at this. So they were mostly in the 6%. Okay, so fast forward to today, right after lockdowns, right about here, look at how historically low the interest rates went. And here's the problem, y'all, and this is why we don't want low interest rates. Low interest rates will actually kill us, not help us. As you can see right now. The problem is as you can see here, interest rates stayed too low for too long. The quantitative tightening should have happened in 2021. It did not. It started happening in basically the end of Q1 of 2022. So look at this. Now that they've ran up interest rates right here, now we're fixing to pay the price, right? So they had a huge run up of interest rates, and now we're going to start seeing, things break essentially, and we're going to start seeing how much of the economy over the last 3 years were dependent on low interest rates, right? And I'm talking like 2 and 3% interest rates. And another problem was the inventory, and this is the inventory, the active inventory count by Fred economic data. This goes back to 2016 because I just want to show you guys the seasonal patterns of inventory. All right, so here's the seasonal patterns of inventory. We need, at peak about 1.3 down to about 1 million houses. So if we have 1 million to 1.3 active listings, we're going to be in the same situation we were in pre-COVID, only things are much worse right now, right? But look at this, guys. So as soon as we got out of lockdown, now, first of all, why didn't supply come back? COVID, we were in lockdowns. Builders stopped building, people stopped listing, but the hunger to purchase increased. Why? Well, I just showed you guys 2% interest rates, plus during this time, free money, PPP, all of this stuff. So people flooded the market and purchased, and inventory never rebounded. And that's what happened here. It just went straight down and never rebounded. And then it kind of went up a little bit and sank to historic lows around February of 2022. The beautiful thing is right now we are breaking seasonal trends of inventory growth. All right. So it's only gone down, unlike these areas where it kind of goes straight down like this. Look at it's barely went down at all. So I'll be keeping my eyes on this chart, obviously, as we go into 2023, and I'll bring up any continuation of the patterns. So if we fast forward to right now, I just want to show you guys where we're at with sales, or pending sales rather. Now, as far as year over year, we're down, y'all, because I'm about to pull up some articles right now, and I'm going to show you what they were saying back in 2007. But right now we're down 34% in pending sales year over year. 34%. Astronomical, far from seasonal, far from seasonal, okay? But now, guys, what I'm going to do is I'm going to jump into some articles in the past so that we can see what people were saying in the past and compare it to what people were saying right now. Take a look at what I found. So let's start with this NBC article titled, "New Home Sales Fell by a Record Amount in 2007. New home sales plunged in 2007 by the largest amount on record, while home prices tumbled sharply in December. Analysts forecast more trouble in 2008 as housing tries to emerge from its worst slump in more than 2 decades. It goes on. The Commerce Department reported Monday that sales of new homes dropped by 26.4% last year to 774,000. So right now, obviously, guys, we're seeing even greater declines in sell. And I also highlighted this. I think this is very interesting. We have another appearance from our friend Zandy right now, basically warning people in the past of what's potentially coming. Let's read this. And the slump in sales and prices appear to be worsening at year's end. December sales fell by 4.7%, a bigger than expected drop, while the median price by homes fell by 10.4% last month when compared to December. So they're saying December to December, home sales dropped about 10.4%. Remember this, you guys. This is the median sales price from Redfin, from peak, which was 389. They actually changed that. It used to be 391. They keep changing data to about 350. So we're almost 10% down, 10% off from peak right now. Let's get back into the article. It looks like the floor fell out of the housing market in December, said Mark Zandi, chief economist at moodyeconomy.com. Do y'all remember me quoting Mark Zandi a lot? So he was warning people back then as well. But again, you guys, people for some reason keep their heads in the sand. He said the current slump is already on par with the deep housing downturn of the 1980s and could end up being worse than the post-World War II period. The data of new homes followed earlier reports that sales of existing homes dropped 13% last year, the biggest decline since 1982, while construction of new homes and apartments fell by 24.8%, the largest drop since 1980. Zandy predicts that sales of new and existing homes will likely hit bottom this spring and that construction will level off this summer. But he said prices will likely keep falling for the entire year as weak demand forces seller to cut asking prices even further to move home. So do me a favor, guys, comment down below. Let me know if you think that we're reading some of the same things right now. It's just there's so much noise from people like investors, that like to get foreclosures and things like that and are just investing carelessly inside of a bubble. My heart goes out to those people because I really feel like they believe with all their heart that what they're doing by YOLOing their money in the bubble at the peak is the right thing to do. And a lot of them, y'all, listen to like investor YouTubers and like internet stuff and like they just YOLO again, right at the peak, y'all. So many people bought right at the peak, and I'm talking investors. So my heart goes out to them as well a little bit, actually not even that much, because honestly, I've been warning them. Y'all, I'm warning people like, hey, hold up real quick. The rental market's crashing down. You're not going to flow the same. Your cap rate, things are overpriced. Inventory is increasing. But their heads are in the sand, and I believe they're going to keep it there, y'all, until one morning they wake up to the housing market crash and they have lost so much. And that's exactly what happened to millions and millions of people the last time. So why would this time be any different? This one right here is a really, really good article. This is going to be linked in my description, but let's read this and look at how closely it resembles what people are saying right now. Let's read this. Since early 2000, economists have been sounding the housing bubble alarm with increasing urgency. And while many markets around the country have seen price drops in the last year, the dire across-the-board correction that many predicted has yet to materialize. Are we going through that right now? People are like, oh, the housing didn't crash. It only crashed in a couple places. It's only localized. Aren't we doing that right now, you guys? Isn't that what's happening right now? Let's continue. There are several factors that could cause a real estate bubble to burst. Again, this is in 2007. This article is February of 2007. The most important factor, one that is sometimes overlooked, is the buyer and seller sentiment. How we feel about what's likely to be the biggest windfall or biggest purchase of our lives. Isn't that what isn't it? All right, I'm gonna keep reading. Our real estate search and browsing patterns provide a window into the minds of buyers and sellers and offer more than a glimpse of their feelings about the current market. Take, for example, the search for housing bubble. As bad news continues to build around the housing market, you would expect the housing bubble searches would be all-time high. Actually, the opposite is true. As they got closer to the housing market crashed, people stopped caring. Wow. Interesting. Kind of like right now. Let's finish. As the week ending February 17th, 2007, searches for housing bubble have reached a 2-year low right before the biggest financial collapse. 2-year low of people trying to educate themselves. Wow. Shocking, isn't it? Isn't it crazy how, people blindside themselves? Do y'all think it's the media narrative? Who do you think's doing this? Do you think it's greedy investors? Do you think it's investors that are just spitting throw up because they don't understand what's going on and they want to continue to make money? Do y'all think that's what's happening? Do you think that's why so many people are clueless? And again, here's the thing, you guys, just prepare. Just prepare, right? If you want to buy a house, buy a house. I'm not saying not buy a house. If you buy a house, you understand though, it's a falling knife and it could be an horrible decision if you just recklessly go out and purchase. You have to be very, very tactful. Let's finish reading. As the week ending February 17th, 2007, searches for housing bubble had reached a 2-year low. Only 4.4% of searches on the same subject that occurred during the second week of June 2005. A media frenzy around a pending correction occurred that very same week, which demonstrates just how suggestible we are, as well as how short our attention spans can be. Do y'all hear me on that? Interesting. Let's keep going a little bit more. But while the bubble seems not to be a major concern, this is a growing game of chicken between buyers and sellers. Isn't that what? Isn't that, you guys, isn't that what we have? Is that what we have right now? I'm just saying, you guys, y'all see the patterns here? Do y'all see them? And I'm the bad guy? Do y'all see why I'm drawing my conclusions here? Let's finish. Searches for homes for sale have outnumbered homes for rent by nearly 3-1. As of the last week, that margin was cut nearly in half as online searches indicated their willingness to at least explore renting pending a drop in home prices. So here's the thing on this housing market crash. People are renting less and the inventory for rental homes right now is absolutely skyrocketing. Very, very intriguing. Very intriguing how history, maybe it's not the same, but it certainly rhymes. Don't you agree? So in conclusion, you guys, basically there's two things that we don't have right now, which, was kind of a catalyst for the last housing market crash, which is spiking unemployment and foreclosures. So what I really want to show you guys is where we're at right now compared to back then from unemployment and a foreclosure standpoint. And this is what I want you guys to understand. This happened almost overnight, right? The warnings were there for years. People could have saved, so including myself, because I lost everything. The warnings were there. And the reality is in 2007, it did not appear that we had too much problems. Did you hear me? In 2007, looking at just unemployment and looking at just foreclosures, 2007 would not alone with those two things would have not indicated what was to come. Let me show you. So here's the Fred economic data unemployment rate. This goes back to 2004. And what I want to show you is right before the Great Recession. Let's look at 2007. Okay, so 2007 is about right here. So 2007 started with only 4.6% in unemployment. Look at that. So it's actually, mid fours right before the Great Recession. Do y'all see that? But look at when the recession hit. Look at this. Look at how fast it spiked up. Gone. Look at this. Spiked all the way up to about 10%. And look at how long it took to rebound. Isn't that amazing, you guys? Now, I just want to point out also where we started in 2002. Look at this. We started 2002, 4% unemployment. So where we started in 2002 versus where they started in 2007, only a 0.6% difference if you believe these numbers. If you believe the unemployment numbers, which I don't, and I'm going to show you a video right now that helps explain why I don't trust these numbers, essentially because they keep changing the information on us, right? But you guys, we're only 0.6, listen, 0.6% in unemployment versus the start of 2007 versus the start of 2023, only 0.6. Think about that, y'all. Really, here's the thing. I'm going to play a video from No Name Financer. I'll link his video. It's only going to be a short amount that I'm going to play for you guys. But I found this person, a subscriber showed me this video, and I absolutely love this guy and how he broke down the unemployment. So I suggest you go to the link in this description and watch the full video. But listen to what he has to say and why we can't believe the current unemployment rate. Take a look.
Now, you may recall that we've speculated about this for a while, especially based on this report that came out last month from the Philadelphia Federal Reserve, where they had theorized that the Bureau of Labor Statistics for the second quarter of 2022 had been dramatically overstating the number of jobs that the economy had created. And this line here says, in aggregate, 10,500 net new jobs were added during the period rather than the 1,121,500 jobs estimated. So this is the Philadelphia Federal Reserve is saying, hey, Bureau of Labor Statistics, you guys were way off with your jobs numbers last year. Well, you can put all speculation aside, folks, because yesterday at 10 a.m., the Bureau of Labor Statistics very quietly dropped this absolute bomb on the world. This is the quarterly data series on business employment dynamics. And I challenge you, do a search in Google News or any mainstream media outlet and see if you can find any reference to this report. I have not been able to find any. And you have to scroll down in this report because this is for the second quarter of 2022, the same numbers from that Philly Fed report. And look at this here in Table A on this report, the 3-month private sector gross job gains and losses seasonally adjusted. And look right here, the net employment change for the 3 months ended June 2022, negative 287,000 jobs.
So what do you guys think? So how do you get 1.1 million jobs wrong? How do you do that? Do y'all see why I don't want to be conspiracy theorist here, but I don't trust this information for many reasons. And again, listen to his video. It's Nobody's Special Finance. I subscribe to his channel. I'm now a fan. I absolutely love what he's covering as far as unemployment. He's way smarter than me when it comes to that. So in other words, you guys, I wouldn't trust where we're at with unemployment. And the reality is unemployment could skyrocket up tomorrow. It really can. I mean, we have all of the elements for that to happening. No more than quantitative tightening and the Federal Reserve trying to crush us, right? In the labor market. That's a pretty big deal. But now let me show you where we're at with foreclosure. So this is a chart I love to reference by Black Knight, and I want to point out where we were at the beginning of 2006. So the beginning of 2006, they only had 76,000 foreclosure starts, okay? But not only that, what I want to show you is serious delinquencies for the start of 2007 and the start of 2006. And the reason I want to point that out is that's where we're at right now. So right now, we're at this level of serious delinquency right now, all right? Where we're off a little bit is right here, total non-current. As of right now, we're at 1.85. So, so in other words, 2007 started with another million people behind on their mortgage. So in other words, although it's not the same, we have historically low defaults and foreclosure right now, but I have to remind you guys, the reason that is COVID and the foreclosure ban. That essentially reset the entire clock to foreclosures. And that's why in 2022, we really didn't see anything. We kind of just saw shuffling of data, a little bit better here, a little bit better there. But overall, you guys, in 2023, we're going to start seeing foreclosures go up. We're going to start seeing defaults go up. My question, though, is going into the next few years is how effective will loan modification be and how many people will loan modification save? And also, will we have any bank runs? If we have any bank runs, you can essentially kiss loan modification goodbye. In conclusion, here's what we have to do. We have to be cautious. We have to be careful. If you insist on still buying, go out there and purchase, but understand where we're at right now. Come up with a plan, a game plan, right? How to get through a recession. Now, here's the thing. Here's a beautiful thing about what I'm saying. Some of the best buying opportunity comes when we purchase in and shortly after a recession. Okay, so by all means, go buy right now. That's fine. If you can cash flow, if you can get homes for under market value, if you can lowball, and if your mental health is so messed up that you must buy, you guys go ahead. But I'm just saying, be super cautious, be super prepared, because the reality is right now, based on history, based on what's going on right now, the longer that we wait, the better deal that we can get. And the sooner that we purchase, the more at risk we really are. Now, other than that, guys, I hope you guys got some new insights, value, and perspective in today's video. And if you're out there investing in real estate, I wish you luck and I hope you win.